A very good afternoon and welcome to HYCM's online trading workshop with myself, Giles Cochran, Chief Currency Analyst here at HYCM. A very warm welcome to you. I'm looking forward to taking us through the current session and just explaining what's been moving the markets at the moment, where we're at. I'm also going to update you guys with a couple of trades, one that I've exited and one that I've entered. So I'll be running through that as well during the session. Now, don't forget as we go through the session that you can submit questions and answers in the question and answer box, which is at the bottom of the screen. So do make sure that if you have any questions, just enter them during the session, and that's very helpful to have those questions. Any trades you're particular in, do enter those. Secondly, I want to make clear that as we're going through this, the whole idea of this webinar is that you're looking over my shoulder, someone with a professional trading background, and you're seeing how I go about making decisions. And this is about an education service to understand how to trade the market. So it's not me telling you to buy or sell at any particular situation, even though we're looking at levels of buying and selling and stops and take profits, etc. The whole idea of this is that it's an educational perspective and to improve your trading and your outlook on the market. So that's the whole spirit in which this is undertaken. Just to remind ourselves, as folks are still coming in, the key aspect that we're always looking, whenever we're trading, particularly when we're trading currencies, we're looking to trade strength against weakness. So we're looking for reasons for a currency or even a commodity to be strong, and a reason for, when we're pairing currencies, for another currency to be weak. So just like you would always back the strong arm to beat the relatively weaker arm, in the same way you back the strong currency against the weaker currency. That's what we're always trying to do, always trying to identify weakness and trying to identify strength. So in the session ahead, I've got a couple of special things to look at. We will be looking at Europe's largest trading partner and how that impacts FX. So that's a little special topic that we'll be looking at. Last week we looked at Australia's largest trading partner and how that impacted the Australian dollar. So do look at last week's webinar if you want a little bit of a refresher on that. Okay, what we're going to do now is we're going to recap ourselves where we are in the market. So I'm just going to go over to the other screens, and we'll just have a look what's going on at the moment. Now, the main event that we have at the moment has really been spurred by President Trump. President Trump has recovered, he's out of hospital, and he's feeling better, so much so that he is starting to be up and tweeting again. And he set the cat among the pigeons, so to speak, last night by announcing he's walking away from the COVID relief talks before the US election. Now, the reaction we saw in the market was strong. So we saw strong selling in equities. We saw volatility spiking higher. We then saw what we'd expect, gold shifting lower, and we saw the US dollar moving higher. That's the reaction that we'd expect. I saw the report, the tweet come in, and I sold gold. I've taken profits now on that gold short, and I'll explain the reasons why. Now, just because President Trump has said that, what we have to be aware of, and we have to be aware of this fact that although equity markets are sold off, equity markets are aware that some fiscal stimulus is coming. Now, the reasons they're aware that some fiscal stimulus is coming is because at some point, whether President Trump or whether Joe Biden wins the US elections, both presidents, you know what I mean, both candidates will release a wave of fiscal stimulus that will support equity markets. So think of it like this. It's a bit like a parachutist. A parachutist jumps out of a plane, and he knows as he's falling, he's not worried he's falling because he can pull the parachute at some stage. Now, he might pull the parachute at 7,000 feet, or 5,000 feet, or 4,000 feet. He can pull the parachute at different times, but the bottom line, he has a parachute. We may be seeing a similar reaction to that in the markets at the moment. Yes, President Trump has delayed stimulus, but the financial markets realize that stimulus is still coming. Now, this is the area to watch. If we get a President Trump victory, that should be an upside in equity markets. And also, if we get a Joe Biden victory, that should also be an upside in markets. Now, in one sense, the Biden victory is probably better for equity markets, because if Joe Biden gets a victory, then that's likely to be a much faster and larger fiscal stimulus spending package. So if Biden have a widening majority over President Trump, if President Trump is basically done for, and the polls keep indicating that Biden is gaining in the polls, he's getting a bigger and a bigger lead, that is going to be great news for equity markets, because they're expecting a faster and larger fiscal spending package. However, the slight downside is that there is potentially going to be higher taxes under Biden, but a larger fiscal stimulus package should keep equities supported for now. Okay, now if that starts narrowing, if it becomes like Biden starts losing some of his lead, then I would anticipate that to be, more of a risk factor. So what equity markets want to see is a Biden win, and they want to see that getting bigger and bigger and bigger. And as long as that happens, you'd anticipate equity markets still rising. Now, I have to say, we have to see how the US digest the morning after the night before, because the reaction we've had so far, Euro stocks pushed up towards the highs of the day, ASX 100 pushing up to the 200 to the highs of the day. I initiated a long on the ASX 200. I'll explain why in a moment. FTSE 100 up high. VIX volatility just pushing lower. That's good news for risk. Okay. As VIX drops, that's positive for risk. Now at 2:30, about 1 hour UK time, the cash open will happen in the US markets. Now the cash open is when the cash markets open. That is when, like, the S&P 500, NASDAQ, Dow, these in front of us are the futures markets, right? So when the cash opens, if that opens positively, then that narrative the market's latching onto, that stimulus is coming at some point, whether it's Biden or Trump, it's coming, so we can allow risk, we can allow the risk on mood to carry on. So that's why the market's in this kind of consolidating mode. You can see that consolidation happening with the dollar. Dollar rose. Remember, the US dollar is acting as a risk currency at the moment. So when equity markets are falling, we see the dollar rising. Just have a look at that here. Let me show you that nice little spike higher in copper there. That's obviously positive for risk. Let's just show you what I'm talking about here. If we overlay the dollar index, right, what you can see that as equity markets rise, the dollar's weaker, right? The orange line is the dollar index. You see, when we have that heavy selling off in equity markets, we see the dollar rising. Now, if you go this onto the daily chart, you'll see that it's a good correlation, okay? A falling equity market is a rising dollar, okay? A falling equity market, a rising dollar. A rising equity market in the US is a falling dollar, okay? So that is the way that risk is working very, very clearly at the moment. That's what drives the dollar. Now, you want to know what drives the dollar, because the dollar is the most traded currency in the world. 70% of all currency transactions involve the US dollar, and the path of the dollar obviously impacts the major dollar pairs. So when dollar's weak, that's upside in the Aussie US dollar, pound, New Zealand US dollar, upside dollar CAD, okay? So that's the general playbook. Obviously, CAD gets pushed around with oil as well, so you have to factor dollar CAD. But certainly with the Aussie, Euro, New Zealand dollar, weakness in the dollar index boosts up the major currency pairs. So that is where we're at the moment. US is coming online, and at the moment that risk sentiment is turning a little bit more positive on the day. So the way we assess risk on a day-to-day is very simply like this. We go through the major markets. So let's start by doing that. So first of all, here's the future markets. Future markets have been sold off, but they're moving higher on the session, okay, pushing to new highs across the US futures, and then we're seeing pretty well supported across the rest of the futures markets. Looking at bond yields, see bond yields pushing higher, that's positive for risk. So risk markets moving higher. The Italian 10-year bond spread is dropping, that's positive for the euro-US dollar. We are seeing gold finding some legs, copper pushing higher, oil complex pushing higher. There are a number of hurricanes in the Gulf of Mexico that drops supply for oil, so that's why we're not surprised to be seeing upside in oil at the moment, and copper prices pushing higher as well. There are some potential strikes to be going on in the largest producing copper country in the world, Chile, and that's helping support copper prices at the moment. And then looking at the major currency pairs, we can see that the dollar is weakening, and that's positive for risk sentiment. So risk sentiment is shifting towards a more positive tone, and that will be important for the session ahead. Now, the commodity that I've got my eye on at the moment is gold. And at 7 o'clock UK time, we have the FOMC minutes coming out, okay? And you can see gold is at this very key trend line here, okay? As long as price stays below that trend line, the gold bulls are being, restrained. What gold bulls want to see is to take above that level. Now, the FOMC minutes could help do that potentially. Now, this is what to look for. The Federal Reserve have moved to an average inflation targeted scheme. What that means is that they are prepared to allow inflation in the US to overshoot before raising interest rates. What that means is that they will keep interest rates low for longer than inflation would necessarily warrant. So if you look here, you can see government 10-year yields are very, very low, okay? And they have been very low because of this interest rates are being cut, so that increases the value of bonds, which reduces the yield of the bond. Now, as long as this remains lower, this is positive for low interest rates. And you can see here this very, very deep downtrend that we've seen in bond yields coming on. So if the Federal Reserve say something like, the longer that they expect inflation, they're going to allow inflation to overshoot, and the higher they'll let inflation overshoot, that means the more bearish outlook for the US dollar and the better strength for gold. So keep an eye on gold, particularly moving in to what we're seeing with the FOMC minutes. There's a potential to be moving there. And also notice this with gold. Gold is being shifted and moved around a lot with the stock market. So if we see, I'll show you what to look for. All right. So when you see stock markets falling, that is negative for gold, okay? So a falling stock market tends to be negative for gold. Let's maybe look at the NASDAQ, might be a slightly better example. You can see that falling equity markets is falling gold, falling equity markets, falling gold, rising equity markets, rising gold. So if equity markets start rising high, that's a positive for gold. So notice that the equity market and gold market is very closely correlated, particularly at the moment. So what's positive for equities is also positive for gold. So that's one market that I'm looking at very carefully. The other market that I'm looking at very carefully at the moment is the ASX 200. Now let me just talk us through that. Now this is the ASX 200, and I entered a long position on the AX 200 this morning. Now, let me just explain the rationale for that. If you look here, you can see that this trend line has been broken higher on the weekly chart. Price is trying to break above this key trend line. Now, there's reasons why that makes sense. And some of the reasons that that makes sense are as follows. First of all, we have had the Reserve Bank of Australia, they met this week, rather. And after having met this week, they have kept open the opportunity, the option of interest rates being cut. So that has meant that Australian yields, let's just put that on top. So let's just put the Australian 10-year bond yield on. So the Australian 10-year bond yield has been falling, okay? So here you can see that the bond yield has been falling, and if we look at it on a weekly perspective, on a daily perspective, you can see that bond yield has been moving lower, okay? So basically, the bond yield moving lower means that the RBA is moving towards negative interest rates, which means weakness in the Australian dollar. Now, first of all, that is good news for Australia's equity markets, because a weaker Australian dollar means stronger export market, and that's better for Australian economies, for Australia's stock market and the companies in Australia. That's number one. Number two, the Australian government has released an aggressive stimulus plan, and they are supporting Australian companies, and analysts are basically saying there's going to be few losers in stock. So it's great news for the Australian stock market, and this government support is so large that the fiscal deficit is going to be a peacetime record. So the last time the Australian government borrowed so much money and had such a deficit in their plan was during a wartime. So that just gets you know, this is a peacetime record in terms of stimulus from the Australian government. That is also set to boost stocks. And if you notice that Australian stocks have recovered since March's lows, which is the ASX 200 here is the white line to give the grainy picture, but the Asian stock market has done better. So this should allow the ASX 200 a little bit of room to catch up. So breaking through this trend line here was a great place to enter. I put my stop here just below 5,600-ish region. I'm looking for a move back up towards 6,480, that kind of region. So something up here into this overhead resistance level looks like a sensible place to take profits on a first test. Okay, so that's the reason for that trade I've taken on the ASX 200. That was a trade I opened. Here's the trade I closed. I closed the Australian New Zealand dollar long, and I'll explain why. First of all, you can see here that this trade I entered, Aussie New Zealand dollar long, was based on a divergence between the RBA and the RBNZ. Right, the Reserve Bank of Australia, they are moving towards a rate cut now, whereas previously RBA were keeping rates on hold. The RBNZ were potentially moving to negative interest rates next year. So there was a clear divergence between the two central banks. That divergence has now dissipated somewhat. The RBA and the RBNZ are much closer together. And for me, seeing this bond yield spread, you see how closely the bond yield spread matches one another. So you can see that as the bond yield spread moves higher, this is the Australian 10-year bond minus the New Zealand 10-year bond. As that spread, that is the subtraction of the two yields. You see that as that bond yield spread moves higher, Aussie New Zealand dollar moves higher. As that bond yield spread moves lower, the Australian New Zealand dollar pair moves lower. They're very closely correlated because it's the bond yield spread. Yes, but the reason I've exited is you can see the bond yield spread moving lower now. You can just see it's pushing lower, wanting to break through that lows, which would be indicative of weakness in the Aussie New Zealand dollar moving forward. And you can just see that price is just testing this overhead resistance level here. and you know, just see price testing that level at the moment. We'll see where things close today, but I closed my Aussie New Zealand dollar longs because that bias, that divergence was no longer open. Now, price might keep moving higher for sure. I haven't got a problem with that, but that clear central bank divergence, the fundamental reason for the trade, has now disappeared. And I'm always looking to combine the technicals and the fundamentals together. You can see here, that's the technicals, the break of the trend line, that we've got the fundamentals for ASX being supported. That's the kind of trades we want to be involved in. That's the kind of trades we're looking at pursuing. So that's just a by reason of explanation. Now, in terms of the special topic we're looking at, the special topic I want to look at here is the trading partners in the European Union. Now, the largest player in the European Union is Germany. Now, that's important for FX markets, because you'll notice whenever you're trading, German data points has a disproportionate impact on the euro currency pair. So German data has an ability to move the euro in a very strong way. Now, particularly what drives the European Union is particularly the manufacturing out of Germany. So the German manufacturing data is very important for the Eurozone as a whole. So the first point to be aware of is that Germany is the largest trading partner of the EU and has the kind of the most influence out of the 27 or so member states within the European Union. So that's the first thing to be aware of. And obviously the three major blocks in trading in the world are China, Europe, and the US. Number one is the US. Number two is now China. Number three is the European bloc. China has just overtaken the European bloc as the largest partner. So number one, US, number two, China, and a very close third is the European Union. So that's one thing to be aware of. You can take a screenshot of this, but that little point I just want to make you aware so you can know that German data has a disproportionate impact on European Union data. And obviously, when you get something like positive data out of Germany, then when you get the European release as a whole, the German data has a disproportionate impact. So often you'll see this in trading. If there's a a strong data point comes out for Germany, then traders know that that's going to feed in well to the whole European Union data also. So that's the kind of way that that will be looked at. Okay, so key risks that we have ahead, and we do have some key risks ahead. The first key risk is obviously the US stimulus bill and the presidential election. So I'm just going to go through you with it, how it's going to work. Okay, a Biden victory is upside in equities and probably weakness in the US dollar. Okay, so if Joe Biden wins, expect the US dollar weakness to carry on. And that's because the president, if there's a President Biden, he's likely to reverse some of the hostile policies, the protectionist policies that President Trump has had. You think about who President Trump likes to have an argument with. Remember, he had an argument with Canada and Mexico with the USMCA trade deal that was formerly known as NAFTA. He's had an argument with Europe. He's had an argument with Scotland. He's had an argument with China. President Trump has a America First mandate, and it's a very difficult and uncomfortable global tone that is set by the US. So if Biden wins, that tone will change. You'll see, obviously Biden walking back from some of those protectionist policies. That will be good for the globe as a whole, but it will result in weakness for the US dollar. So that's what a Biden win might mean. A Trump win is more likely to, again, upside in equities, but it's more likely to be US dollar strength. We'll get more antagonism towards China. It will be more tweeting about, you know, China, we've got to do this, China, we've got to do that. And it might be a smaller fiscal package, but it should also be lower taxes and more regulation. Okay, so that will be an upside to equities, and strength in the US dollar will be expected. So that's the election risk coming in. So if Biden looks like winning, then that should be a weakening impact for the US dollar. And then also the other thing to look out for is Brexit tweets. Now, Brexit tweets are happening very, very regularly now. Trading the pound, you need to do it with a professional news squawk, or else you need to wait for some clear direction. Because by the time you get the news, the move's already happened unless you have access to a professional news squawk. So what you're looking for in the pound is there's lots of short, sharp moves. It's being pushed around on Brexit headlines. Get either professional access to a news squawk, or just wait for clear direction. So a deal to be done or a no deal Brexit, and then join that move. But that's a headline risk at the moment. And we also have obviously general tweet risk from President Trump. He's obviously pretty liable to do unpredictable things, and if the polls are to be believed, which I think they are, Biden's getting a bigger and bigger victory, so we may see more and more desperate action from President Trump, trying to change things at the last minute, trying to unsettle the political process. So there is political risk at the moment, so be aware of that going forward. They are the main aspects in the market. We've got a little bit of indecision at the moment, so that's why we just need to wait and see. There isn't a clear direction that I can see. As I said, I've shown you the clear direction that I can see in the ASX 200. I've gone through my rationale for that. It's also there on my blog. So if you haven't got access to my blog, it is just here. So I'll just send that out to everyone in the chat box, so you know. Do have a look. I'm just sending the link there, and you can see I go through that market move today, go through that here, and you can just run through more of the final details for that there. Just go to the blog, and that keeps folks tuned in. Okay, I'm just going to go through now to see if there is any questions that you guys have. Yeah, okay. Okay, Schwa. Euro pound touch trend line, May short. Okay, so we have we've got a trend line. That's the trend line you're talking about. Now, the problem with the euro pound Schwa at the moment is this. Brexit headlines are pushing and pulling this every which way, okay? So you're only going to get something about fisheries or state aid, and the pound euro's moving. Now, if there is a no deal Brexit, if there's negative news, then this is a clear buy on the euro pound. This is a great place to enter. A break of this trend line, break and close above on negative Brexit news would be a great trade. But we need to see negative news. At the moment, the pound's going 40 pips up on one tweet, and then 40 pips down on another tweet. So what we're seeing, Schwa, is what's called headline trading. Very difficult to trade. And unless you have a professional news squawk and are prepared to jump in and jump out, just wait aside. Wait until there's some clear direction, some clarity, or else you'll just find yourself getting stopped out and frustrated, and 100 pip moves against you, and you won't see the reason why. So I would just stay clear of the euro pound, unless you've got a professional trading news squawk, and just wait for that, okay? Today, vice presidential debate, is there any impact to market, especially US dollar? Yeah, there's a lot of headline risk at the moment around a number of different aspects. So it's the stimulus bill, it's what's happening with President Trump's latest COVID-19 diagnosis, How well is Biden doing in the polls? What's the political scheme? So we're getting into high political risk, Shwa. So yes, we have headline risk out at the moment. Yeah, short term for gold, Salman, it all depends on the US dollar. If the US dollar is weakening, expect that to be an upside for gold. Okay, so again, headline risk. Here's the US dollar at the moment. We saw that overnight, we saw the US dollar boosted higher on that risk flows. We've now seen most of that move reversed, right? As long as dollar's weak, Salman, expect that to support gold. But as I said, yeah, how to trade gold. I still don't understand the packages. How to trade in gold. Okay, right. Whenever you're trading in gold, you just go to, you want the code that looks like this, Ashwin. XAU USD. Find that in your MetaTrader 4 terminal. Make sure you can see that one. If you're struggling, reach out to your account manager. They will help you. Okay. So you want to trade in that, and you be aware of leverage. So make sure you're aware of your position size, so you don't inadvertently trade with too high a sum. Yes, Titus, can we touch on ETFs and gold potential? Of course. So exchange traded funds is a way of entering the gold market. It's a potentially more stable way to enter the gold market because you're not using leverage. So you can use a gold ETF, exchange traded fund, and that is a good way to trade ETFs. Now, looking at ETFs, this is what we see. Let me just show you. Right, this is what we've been seeing in global ETFs. Now, exchange traded funds are very, very popular because they're a great way to trade gold, and it's just a very more stable way of trading gold, right? So you can see here that the total known gold exchange traded fund holdings have reached a record level. Do you see the way that they track one another? That as ETFs rise, gold price rises with it. The ETF holdings is the white level, so you can see that as the white line keeps moving higher, you can see that gold tracks it. Okay, so if we see ETF holdings keep rising, then we expect gold to track higher as well. There's a slight divergence. You see the divergence here? Now that divergence doesn't tend to last very long. We had a similar divergence here around May and June of this year. You can see that spot gold price was down, but ETF was making record highs. Look, gold shortly picked up, right? So the way that works, Titus, is that this is a good indicator of future gold price. Not proved, it's not a guarantee, it's not like it's definitely going to happen, but you can see here that close correlation, that close relationship. And look, ETFs are going higher, spot price is going lower. The outlook for gold remains good. US rates are set to be low for the next, till 2023. Quantitative easing is unlimited out of the States, which weakens a currency's currency. It makes gold more attractive, and the event risks that are going on are also very positive for gold. If you look at gold during a recession, what you see is that gold tends to gain in value through recessions. You just look here. 90s, 2001 dot-com bubble, 2007, 2009 global financial crisis, gold rises in value in each and every one. So it's pretty resilient. So gold is seen as an inflation hedge, and my perspective on gold is that the medium-term bullish picture remains. So one area to enter this would be simply the 100 exponential moving average. So entering at market, stops below 1838. 1840 is a pretty good place to enter, or the other entry place, great entry place would be here around the 1800, 1820 level, stops just running around 1780. So entering a market, stops there, or if those stops get hit entering here, stops just around that kind of area. So that's the way I'd look at it. In terms of a technical break, a break of that trend line, and we're off to the races. So I would be looking at a break of this trend line is a good indicator of future higher prices. So if you get a break and close on the gold chart, I would look at that as a potential signal for going long. So that's for the more conservative trader: break, close above, bulls are in charge, close back down, and exit the trade. That's the way that I could be looking at that. Titus, I hope some of that helps for you. Yeah, market very volatile at the moment. Yes, volatility is high, and this is what we'd expect. We've got US election risk, Schwa. We've got Brexit risk. We've got COVID-19. We've got US stimulus bill cancelled, and then what will the total size of the package will be? It's a real mess. So volatility is going to be extended at the moment. FOMC minutes worth looking at, but you know there's going to be lots of Trump tweets. So make sure you're locked into a very good news website. One that can help you is forexlive.com. As some of you know, I am one of their guests analysts there, and I help these guys out from time to time with some analysis. They're a great website and can be very, very helpful for you going forward. So do check that out. I'll also give you another access. I will give you access to a potential free trading squawk that you might be able to use. I'm not sure if the link is still valid, but I have got a link for a free trading news squawk. So I'll just see if I've got that. Just give me a second and see if I can dig that out. I think I've got a 2-week free trial. Yeah. Okay, so I've got a free trial here. You can use this. This does give you access to a news squawk. You just got to cancel the trial before it starts, but that will give you like 2 weeks free, and that will give you a professional news squawk, which can be helpful with these Brexit headlines at the moment. So, you know, even if you're not going to use the service, because it is an expensive service, but it will give you 2 weeks free use of a news squawk. So you'll see how a professional news squawk works at least. So even if it's just for curiosity, you can have a little look at that. Okay, guys, thank you all very much. Don't forget, come back next week on Wednesdays. Remember, these times are for us. These are, you know, one of my most special webinars is doing this for HYCM clients. You guys are all clients of HYCM, and I'm keen to help you get your trading to the next level. So make sure you're going on my blog, make sure you're reading my daily updates, make sure you're coming along here, giving me your trade ideas, start showing me your thinking, and let's see how we can develop and grow together so that we can be, you know, really tuned in to these markets. Bigger picture, lots of volatility ahead, so be careful out there at the moment. We can be getting some large, sharp moves. You need to have your wits about you, and if you're trading, just to remember, we need to be nimble at the moment and wait for clear directional plays. Thank you all very much, one and all, and I hope that you have a very good afternoon. Thank you all for your contributions today, and so yeah, see you next week, Shwa. That's great. Thank you, Titus. Thank you, Shwa. Good to have you. Warren, Will, good to have you too. Look forward to our webinar together. Ashwin, Babu Selva, Suneth, Temba, great. Thank you all very much and look forward to speaking to you soon. Thanks now, guys. Goodbye.